This is Aidan Mills, CEO of Northstar, and welcome to our 2021 annual financial results. Joined with me on the call today, as well as the Kin Communications team, is Rosemary Pritchard, our new CFO. We've got Carson Seaton, the Director of Corporate Development, and in the office here in Calgary is Kelly Johnson, our new Chief Sustainability Officer and General Counsel. So welcome to the Northstar team. And look, this is, I think, the third one of these that we've done. I continue to talk about our commitment to the marketplace for transparency. And so today, this is the opportunity for you to hear Rosemary for the first time, talk us through our financials. I'll give a bit of a corporate update, but as usual, we'll have a Q&A session at the end. If you have any questions, just hit the Q&A button at the bottom of your screen, the button at the bottom, put the questions in, and as always, Carson will host the Q&A session at the end, and we'll walk through some of the questions. So I will hand it over to Rosemary now to talk us through the financials.
Hello, everyone. I wanted to start by having a little discussion about our balance sheet. When looking at the health of a company, and specifically a balance sheet, I usually like to see three things. One is that we have enough available cash. The second is that we have a healthy working capital. And the third is that we have a low debt to asset ratio. Why are these things important? Well, cash is obvious. We need to ensure there's enough cash available in the bank to run the business and cover expenses. But the healthy working capital is also important because it shows the company's total available liquid funds and ensures the company is making timely payments of any liabilities. The low debt to asset ratio is also important because this is what creditors look at, and they want to see a low ratio to ensure that any financing that they do is cushioned against losses. So looking at Northstar's 2021 audited financial statements and evaluating them against these three criteria, I believe that we are sitting in a very good place financially. So on the balance sheet, last year we ended the year with just under 2 million in cash, and this year we're sitting at 6 million. We also have a working capital is a surplus of 5.5 million, whereas last year we had a negative working capital of around 62,000. The assets, again, have increased 7.5 million. This was largely due to the equity raise in July and investments into property, plant, equipment. And our debt to asset ratio decreased from 0.52 to 0.25, so we cut this in more than half. So I think we're sitting in a pretty good place. So key notes to the balance sheet. As I mentioned, we did an equity raise in July of about $12.2 million. We also signed a lease for our Delta facility, which you will see on the audited statements as the right of use asset and the lease liability, which is how it's recorded for IFRS purposes. And also an increase in our deposits of 400,000, which was the deposit we sent to the landlord for the lease. The other positive thing is we paid off all of our loan balances of 2.2 million, which was made up of the $1.4 million loan to Van City and 800,000 to shareholders and directors. You will see a little bit of a loan payable on the books. This is just the capitalization of a new equipment loan. On the income statement, once we did the capital raise in July, had some funds in the bank, we started engaging more extensively in R&D activities to get the Delta facility to steady state production. Hence, you'll see an increase in costs in R&D costs. On the general and admin expenses, 2021 looks like it compares to 2022. However, if you remove the non-cash items, which is basically the depreciation and the share-based compensation, the comparative is about 3.5 million in 2021 compared to about 700,000 in 2020. This increase in costs is due to the fact of a few things. One is that we had to absorb the costs of going public, which included regulatory fees, legal fees, and finance charges over $450,000. And since we went public, we've engaged in aggressive marketing activities, which has accounted for another $800,000. We hired key personnel, including securing the founders, Terry and Gord, adding Aidan as CEO, myself as CFO, and a few other senior positions, which were all needed in order to take the company to the next level. And this made up about $600,000 in 2021. And finally, we engaged external consultants to help us with other areas of expertise, such as government affairs, human resources, and corporate secretary. This cost us about $500,000. On the cash flow slide, net income or net loss for the year of 7.2. It's actually around 4.1 million once you remove all the non-cash items. And other large items affecting cash was $400,000 that we paid on the lease, $761,000 that we purchases of plant equipment, 2.2 million of loan repayments, 759,000 of share issue costs from the equity raise, 632,000 of Delta lease payments, and this was offset by 12.2 million in proceeds from the equity raise. So a total cash outlay for the year of approximately $4 million. And just to sum it up, on the equity, we did an equity raise of 12.2 million. So the shares increased from 68 million to 106 million. And the equity value increased from 2.4 to 9.3. And Aidan, I think you had some comments you wanted to make on this.
Sure, and thanks for that, Rosemary, and yeah, thanks for the insight into the business and all the hard work in getting the audit across the line, etc. That's been great. Good for the company to provide this transparency. So there's a couple of things to touch base on with respect to this. If you look at the capital stock figure, essentially the money spent to date, and you look at the current share price, essentially that, signals pretty strongly that there is no premium in the stock price with respect to what we've actually been done and all the dollars that we've invested in this company. So hopefully, as we look forward and as we look at the metrics to come and where we're aiming to take this business, that'll improve. I'm sure everybody on the call as an investor would like to see that happen, but that's obviously one of our goals. I think a really important part about this, and it's not actually in this slide, it's in the IR deck, which is on the website, is the stock ownership. So just over 20% of the stock is owned by insiders. So that's staff, it's directors, it's other insiders, it's people who are restricted, and that shows the level of commitment that the management team, that the directors and the insiders have in this company. So, and a number of you have committed or commented on my ownership level. So as I came out of 2021, my ownership level had increased from starting at 0 to 750,000 shares as I left the year. So this isn't about my level of commitment, but it's about me joining my colleagues in the management team and the directors in terms of our level of commitment for this company. And so we're aligned with all of the people that are on this call. So that's just something I wanted to put out there as we kind of finish 2021. So next slide is our corporate update slide, and let's go to the next one. Look, part of this call is about 2021, and as I say, thanks to Rosemary for taking us through that. But a lot of this is about 2022. So when I'm asked the question, what are we focusing on this year? Every one of the leaders has got a huge area of focus and a widespread portfolio. But there are two things that we're really focused on. The first thing we're focused on is getting the Empower pilot facility to commercial production, such that we get to commercial operation, steady state operation, and also very safe operation, that we're concentrating on the HSE and keeping our people safe. And that's what we do, is we bring the Delta facility up to commercial production. And from the marketplace, to me, we'll talk a little bit about that in detail in a minute, but this is all about taking a pilot facility to a commercial level. So that's our pilot facility. And if we get that to commercial level, that's a great place to get to. So that's goal number one. Goal number two is to start the construction of Calgary. Calgary is the scale-up facility. Calgary is the facility that demonstrates that this technology. So I know a number of you have heard me talk about this. To be a really successful ESG company, you need to do three things. The first thing that you need to do is you need to demonstrate the technology, and you need to demonstrate that it works. The second thing that you need to do is you have to scale it up. And the third thing you need to do is you have to make it commercial. The response to the sampling that has been going on from the asphalt we have been making out of Delta means that I am very confident about our ability to commercially roll this across North America. And we've already done number one. So we've demonstrated that the technology works. So really, the linchpin for this company moving forward is the successful completion of the scale up of the Calgary facility. So let's talk a little bit about those two plans. So this is the discussion around the pilot plant. Look, we're in steady state production, and I do get the odd investor who's like, tell me how many tons you've made so far, and I refuse to answer that question, because basically steady state production means you're running 4 to 5 hours a day. You know, you're running 10 plus tons a day, and you know, you're running 3 to 5 days a week. Some days we're able to run for 5, some days we're able to run for 4. And the thing that's absolutely, there are two crucial things about steady state production. Is number one, it's steady and repeatable, and from that you get to understand how to debottleneck this process, but also how to take the learnings on where this process doesn't work perfectly and apply it to the design of the engineering that is going on for Calgary. So we have a pilot facility that is informing how we do the detailed design and how we do the design of some of the elements of the process in Calgary. We know the process from step 1 to step 15 delivers awesome quality asphalt out the back end of this facility, and fiber and aggregate. But we know that to get to 150 tons a day from 10 to 20 tons a day, that's a scale up, and you need to get that engineering right. And so the steady state production is informing that. The second thing that's happening is asphalt coming out the back end, and I get a lot of questions about, well, how's the testing going? How's the testing going? So look, everybody on the call knows my history was a BP, and I use this analogy. When you decide to produce a BP oil field, or BP decides to produce an oil field, and it starts its drilling, it takes from 200 meters under the ground, it takes up a sample, and it sends it to a number of different refiners, and all of those refiners say, oh, that's interesting, yes, we'd like that when it's available, we'd like that when it's available, and some say, no, we don't really like it. And of the 20 refiners, 10 will say yes, 5 will say definitely no, and 5 will say this is absolutely brilliant. And it's not until you actually produce the barrel can the refiners answer the question about, do they really want it or not? And so we've asserted that our asphalt can go into 3 industries. We've asserted it can go into the paving industry, it can go into the shingle industry, and it can go into the roofing system industry. And that's exactly what's going on now. And the feedback has been strong. I mean, we will PR when the feedback is absolutely clear and we enter into contracts. But if you step back and you think about some of the leading paving companies in North America, some of the leading shingle companies in North America, and some of the leading roofing system companies in North America, they literally have hundreds of millions of dollars of R&D test laboratories. And that's where our product is being tested. And their feedback has been great. So some have said, well, actually, can your process do this? Can your process do that? How does this look? What does that look? What are you doing for your QC? What are you doing for your QA? What are the elements are you testing out the back end? If we did a contract with you, we'd like you to see you to test this. Okay. but this is like feedback from some of the top asphalt R&D people in North America are literally testing our product and giving us feedback. So this point of, when is the first truck going to roll out? At this point in time, my priority is to get the best feedback from the leading asphalt R&D labs all across the country who are telling us what to do with Calgary. And there have been a couple of interesting dialogues we've had with potential customers who've been doing advanced testing where they're like, listen, when you think about the Calgary facility, would you think about this? Which is actually the answer, technical answer is it's very easy for us to do, but very, very interesting feedback. And again, I see no doubt that our product can go into paving and into shingles and into roofing systems. So that's what we've been doing with the pilot facility. We obviously press released early in the journey was the LCA output from Delta. So there's three things going on with the LCA. So number one, as you know, our headline number is that versus the base case, i.e. taking 1 ton of asphalt, putting it into landfill and replacing that with a quarter a ton of virgin production, the carbon footprint's about 200 kilograms, 199.15 when measured at essentially the gate of our plant in Delta. What we produce is about 77, so 60% reduction. Now, that was, of course, estimated. So when we moved to steady state production and we debottlenecked to take us from 10 to 20 a day to 50 to 75 a day. So we will rerun it, we'll measure it, we will redo the LCA. Now, we did exactly the same thing. So the second point is we did exactly the same thing at the estimation stage for Calgary. And that was a very early estimate because we were just finishing conceptual engineering. So now what we're doing is we're redoing Calgary's LCA. We will have that done in second quarter here. Kelly is in the room here, so she's nodding her head. So very confident that in second quarter, we will have redone the LCA. But remember, these are high level LCAs. As we move into production at Calgary, there'll be a whole level of different detail because interestingly, as we'll talk about non-dilutive funding, when government agencies fund you based on the carbon footprint that you're demonstrating, you have to measure it, you have to report it, and you have to do that accurately in a very accurate way. And so as we think about this, and this is part of Kelly's journey as the Chief Sustainability Officer, is if we're demonstrating the ESG capability we have as a company, not only, as I mentioned it earlier on, is HSE absolutely critical, but actually our ability to demonstrate this analysis again and actually understand how it factors into the whole value chain is really important. That's the underpinning of any carbon credit that we can do. So as I've said before, as I've talked about the business model, the carbon credit thing will take some time to do, but this is the underpinning of what we're doing as part of the ESG journey. So then let's talk about Calgary. Look, lots of bullet points down here. Those of you that have seen me on a number of interviews, I've said one of the reasons that I joined the company was to help contribute to energy transition. Look, energy transition for me isn't that we're all going to wake up tomorrow and the only thing we can do is drive EVs and there's no oil or natural gas around. Energy transition is managing between now to the point whereby we can transition away from base hydrocarbons and we can maximize the circular economy to have any hydrocarbons that are in their economy coming back into that economy. Look, some of the thought leadership in Canada is in Calgary, and this is exactly the place to do it. Asphalt is Alberta's darling product. It's what comes out of oil sands as part of that. And so if we can sit in the center of Calgary, surrounded by, again, shingle manufacturers, paving headquarters, and roofing system developers, and we can demonstrate the circularity of our product and saving them energy, not only by buying a product which is a lower carbon footprint, but actually avoiding some of the production that they need to do so they may be able to have carbon benefit, it's a phenomenal place to be. I'm not going to go through all the other points, but the three of the other things I would say is huge government support in Alberta for a transition economy, not only from the federal level, but the provincial level and municipally. Huge support from Calgary itself. Thirdly, we are, there's land availability here. As I often talk about, what we want to do is be so close that the guy who's got a ton of shingles in his truck in the back turns left instead of right. We believe that can be achieved here. And lastly, there's a skilled workforce in Calgary, and both for the site and the headquarters. So I think I think as a first demonstration or first scale up facility, we feel very welcome to be here. Look, I think we've covered most of this. This is kind of where we're at. As I've said, 150 to 200 tons a day. We'll talk about the feed in a minute. Good market conditions, and we've actually so we're close to securing our land, and we've already procured some of our long lead equipment. We've got procurement starting in Q3, and that's for sure. But some of the long lead items have already been secured. Everybody's heard about the the supply chain dilemmas that are going on, and so we've addressed that for any of our longer lead items that were done as part of the front end engineering design. So jump to the next slide, and this I think covers the feed. Yeah, so we press released two things about a few weeks ago. One was the front end engineering design. So 11.8 million bucks, and that includes 20% contingency. There'll be obviously associated costs to ramp up, etc., and lease land, but a capital of roughly $12 million per facility is very economic. And we think it's repeatable. And as we think about building again and again and again, we should have supply chain efficiencies that come in that, and that 11.8 includes full engineering, which doesn't need to be done on every plant. As we've said, these should be modular. It should look exactly the same if you drive past a plant in Toronto, or you drive past a plant in Calgary, or you drive past a plant in LA. It will look exactly the same and do exactly the same thing. And then we also announced the first kind of high level view of our economics. And to be clear, although these were internally produced, they have been reviewed by a number of different financial institutions. So we're pretty confident about this number. When I joined and I was asked what I thought the EBITDA range per plant would be, I was kind of it's probably in the $2 to $5 million range. And now this shows that we're at the top of that. And if you look at the 6 points on the right-hand side, this isn't like a classic CEO arm wave. It's $4 million and here's some sprinkle dust on the right-hand side that we might be able to do. All of these are deliverable. So in that model, we have a conservative asphalt price. In that model, there is no green premium that we've added, no sustainability premium. It's excluded from the pricing. So the core benefit that we give to customers is not included in there. The operational basis of that 4 million is 5 days a week. We believe, and interestingly, I'll kind of we should never do this in a presentation, but do a bit of a sidetrack. One of the things that we're learning from Delta is this facility works best 7 days a week, not 5 days a week, but 7 days a week. There's a hydrocarbon back end, and it's way better to cycle that every day in exactly the same way, day after day after day after day. So the operational upside of that 4 million, so transferring that learning to Calgary means that actually we will likely operate Calgary 7 days a week, and that $4 million worth of EBITDA is based on a 5 day a week production. There's no carbon credit revenue associated with that number at all. So all the carbon credits have been zeroed. Again, as we talked about, in an earlier slide, that is a long process. So we don't want to be signaling to the market that there's upside that's available for that until it is available. Is that may we have the protocols developed and realized by the time Calgary moves into full operation in the middle of next year? Maybe not. But, will it be close? Are we working with customers to really understand how that looks in the integrated value chain? Of course we are, but that 4 million has no carbon credit revenue in it. We've been conservative on the landfill tipping fee revenue, so we have assumed that we're only getting 85% of the shingles coming from landfill, and that 15% will come from partners at zero revenue. And we've associated a discount to municipalities, to municipal landfill, to ensure we attract supply. And then the operating instructions, the yield that we've assumed in this model is 95%, and the output is 95%. So we've immediately discounted yield and capacity to be conservative. So as I say, those aren't 6 fairy dust sprinkle points. There are clear plans behind all those 6 to bring that $4 million number up. Look, everybody who hears that we have a plan to build stuff, especially in this marketplace, starts to worry because it's actually going to cost money. Well, it will. It'll cost capital. That's an absolute fact. But the second point of that is, it has been my commitment from the beginning, and it's been our commitment, and it's been the board's commitment to maximize non-dilutive funding. That's one of the reasons, and Rosemary talked about it earlier on. We brought in some top consultants to help us with this. Wellington DuPont's government and public affairs strategy has been excellent. It's engaged really well at the federal level. It's engaged really well at the provincial level. That's been provincially for the pilot plant in Delta. It's been provincially for here. It's been provincially as we think about other options. So very, very strong, and also potentially, they have the capability to support us as we think about the US. So that's an example of a strength that we have brought in to really help us in non-dilutive funding. And as you worry out there as an investor with respect to spending capital, maximizing non-dilutive funding is clearly a thing for us to do. Okay, and then let's go to the milestones, which is the next slide. So look, I've talked about a lot of these. There's a couple that are on here that are important to think about. I talked about the focus for Delta, and there you have it. At the bottom, it has commercial production. Q2 into the second half of next year. That's our goal. Will it be recognized by the end of June? I'm not sure, but I can tell you, by the middle of I can tell you by the second half of next year we will be in commercial production at Delta. And then you can see down the bottom with respect to Calgary, commence on site construction second half of the year and we've said in the press release the target is to be commissioned and up at least at first operation in by the middle of next year, by the middle of 2023. The two things that are not on here, and I mentioned a little bit earlier on, are of course and where are your sales agreements, and where are your customers, and where's the picture of the first truck going out of Delta. It's my view that we will be again, CEO arm waving, but it's my view that we will have first trucks rolling out of Delta in Q2, and that we will have a sufficiently long-term offtake agreement to underpin Calgary in Q2 as well. I feel pretty confident that that's where we're going to be. Obviously, details, PRs to follow, and can't give any more information on it than that. But that's I think where we would be with customers. Well, you'll be glad to know I'm not going to read through all of these because it's just going to repeat exactly what I've said. So I would hand it over to Carson to field or ask some of the questions that have been coming in.
Okay, we've had a couple questions come in here. So thanks everyone for listening. First question, Aidan, is how many jobs do we expect to bring to Calgary with the new facility?
Between 10 to 15. So the jobs are split between, and the range is because as we kind of rethink the shift system and moving to 7 days a week, it's more likely to be towards the top end of that range rather than the bottom end. So we will have likely 2 shifts internally in the plant, kind of the operations, and then the guys that are outside or gals that are outside doing the outdoor handling. That will probably be, a 5-day a week, because the grinding and processing equipment in the back end is easily sufficient to cope with that volume during the week. And then we would have a 2-shift system operating 7 days a week with the operation. So roughly 10 to 15, probably, closer to the upper end of the range as we think about 7-day a week operation.
Okay, thank you. Next question: do we have any competitors in the sector?
We do. So if you look at the figures that I've used before, and you think about thinking about the US and thinking about the 13 million tons that come off roofs, about 1 million of that is ground up before the remaining 12 million goes into landfill. So 1 million is generally, that's called RAS. So if you Googled it, it would be called recycled asphalt shingle. And there's RAS contractors all around the country. So RAS is what we do in the first step of our process. So we get the shingle, we grind it up, then we put it in a shaker, which kind of sorts it. And out the back end of that comes essentially, just an idea of like grinding up a shingle. So the issue with that is quality control and consistency. It's difficult to pick up a spoonful of that and know quite what is in the tile. So as you know, as I've said before, shingles 50% sand, 25% fiber, and 25% asphalt. And what the paving guys really want is that bound together as it gets integrated into the road. So in a number of jurisdictions in the US, and I can't quite remember the number, but there's a number of jurisdictions in the US where you could put up to 5% of RAS in hot mix that goes on for paving, but in a number of different areas it's banned. And so, for example, in Alberta, you can't use it; it's banned. So regionally, as you think about North America, that's probably the biggest area. And look, are there other people developing technologies? For sure. And if you go on a number of the different websites, the roofing association websites, etc., you can see that there are people trying to develop technologies, like ours that do some recycling. I don't believe that there is anybody who is as far on as we are, and that actually has a commercial product coming out the back end of their facility. I don't believe that there are people who can, as I've said, spend $12 million worth of capital and deploy one of these facilities in every single city that is over 1.5 million people in North America. I believe not only do we have the technology, but it's small enough, cheap enough, and deployable enough that actually the rollout of this technology is very, very strong. But if we step back and we look at exactly the words we talked about in energy transition, 12 million tons of asphalt shingles going into landfill in the US is the equivalent of 18 million barrels. That's a crazy amount of oil going into landfill. And so if there are other competitors, that's actually a good thing, because we will be able to solve, in major cities, we will be absolutely a part of the solution to solve the problem. But ultimately, it needs more than our technology to solve a 12 million ton problem.
Okay, thanks, Aidan. Next question. Can you speak to the liquid asphalt market, and what kind of pricing do we expect to be working with?
Well, I can speak to the liquid asphalt market. I will not speak to the type of pricing we are expecting, but I'll talk about how we are structuring the pricing. So look, the liquid asphalt market is not, as no doubt people can see, it's been pretty high. Actually, Carson, do you want to give the 5-year figure for the Edmonton rack?
Yeah, I believe it's the last trailing 4 years, the average is about $750 Canadian per metric ton.
Right, and so I think we now have asphalt in the range of over $800 a ton across Canada now. So that's the index price. So look, in BP, in Goldman, or wherever I was, the way that commodities are generally priced is a price structure which has an index price. Then it has a location differential. So if you're like in a jurisdiction that has no asphalt production and it costs $200 a ton to import it, you get some of the benefit of sharing of that. So there's a locational differential, and sometimes that can be zero. If we built a plant in Edmonton right beside Imperial, there's going to be no locational differential. The third element will be the quality differential, and the quality differential is interesting. So it's kind of like, well, how does this blend with another product? Can you forego some energy? So our assertion with the shingle manufacturers is there may be 2 steps in their process that they can forego and blend our stuff into the middle of the process. Okay, is there any sharing to be had for that? Is that kind of like a processing benefit? And then the last thing is the sustainability. So and there may be times where, like, if you look at WCS to WTI, that number could be negative. And so it just depends on the industry. It depends on the customer whether that quality is a plus or a minus. Can be plus, but it also can be minus. And then the last thing is the greener sustainability premium. Ultimately, I think there's 2 elements for this. The first element is I continue to show customers that 60% graph that I showed you. This is the cleanest, this is the lowest carbon footprint asphalt in North America, full stop. That's our assertion. We truly believe that. And so I would like this business to be rewarded for that. I can't, so why I won't answer the question about what the dollars and cents of that is because I don't know. I don't know. And I know a number of the customers that have been talking to us are talking to us absolutely because they have a huge sustainable mandate. They have shareholders they're under huge ESG pressure. They have shareholders asking them how they're going to make their business cleaner, and they see our product as a fit for that. I don't know how to value that. I think the second part of it is, and we talked about it earlier, when we bring this low carbon product into their process and enable them to help save carbon efficiency for the front end of the process, what does that carbon benefit look like for the whole integrated process? And how do we monetize that? So I don't know the answer to that question. It's something we clearly see as an advantage to our product and an advantage to their process. But monetizing that is that's part of Kelly's job, and that's part of the protocol we need to establish, and it's also part of the feedback from the customers. So we can't. That second part of the sustainability premium is difficult for us to say. So that's again a lot of CEO arm waving to avoid the specific answer about what the price will be.
Okay, thanks, Aidan. We have a lot of questions here, so we'll try and get through a few of them here. This question, it relates to our growth plan. I guess, what does the timeline for growth after Calgary look like? And once Calgary is complete, where do we expect to build the next facility? And what factors will be used in evaluating the opportunities in Canada versus the US?
So I think we've been pretty transparent and kind of saying, look, we think we should have a phase 1, and that has Calgary as a first plan, likely Toronto as the second. So sorry, Calgary has been approved by the board as part of the strategy, but not approved by the board yet. Is Toronto as the second facility, and Pacific Northwest, likely either Seattle or Portland as the third. The reason that we wanted to do 3 before we went on the phase 2 of the significant rollout of 10 or more, why we did phase 1 was we said, okay, let's demonstrate we can build plants. We have good capital control. We have good leadership and management, especially when it comes to establishing the safety culture and creating safe working environment for our people. Making sure that we could demonstrate the EBITDA coming out the back end, so it's no longer arm waving, and of the 6 things we identified that actually we're delivering in a whole load of those, and it's well over $4 million. And really taking our time to de-risk this technology. Look, Calgary is completely de-risking this technology. So in a perfect world, I would like to have Calgary built and then having de-risked the technology, be through some of the early engineering in Toronto and then follow that quickly with Seattle, such that, we had all 3 plants under construction. Sorry, Calgary finished, but all 3 plants under construction by the end of next year. But I think, as I said, the 2 things we are focusing on this year very, very clearly is getting Empower up to commercial production and building Calgary. I think we have to build and de-risk Calgary, and how fast we can move after that is a bit of a function of how that process actually goes. I think we need to tell the market we are being absolutely clear on Calgary's success, because that is the linchpin for the future of this business. So that's kind of where we're at. And the reason that we're thinking about those locations, of course, is customer, size of market, and government support. So all of those locations have, a great market, really strong government support, and we are in, really good detailed engagement with all of the 3 sectors that I talked about earlier with respect to location.
Okay, thank you. Just a couple more questions here, but I guess next question would be related to opportunities for possibly licensing or franchising the technology.
Yep. So I presented at the American Roofing Manufacturers Association this week in Kansas City. So it sounds like a very internal club, but it's literally all of the top roofing manufacturers in North America. So all the top names are there. And so what I said was, look, once we finish this first phase 1, and we think about the rollout of this plan, and it goes back to this, my view of, to solve this. Let's step back. I think the capability of Northstar will be to build probably 4 to 6 when everything's planned and all the phase 1's done, and everything's delivered, and we've de-risked all these plants. And we're jumping 5 years ahead, and we're 3 years ahead, and we're in the middle of rolling plants out. I think we can probably roll out 4 to 6 plants a year. I don't know if we are rolling out 4 to 6 plants a year that we can solve the 12 million ton problem as fast as we want to. So I do believe that licensing will have to be part of that strategy. We've done no more thinking than say that, to be honest. But I can tell you at the ARMA meeting, a number of people would have said that licensing is an important part of the business model that we should have if we want to solve this problem as quickly as we want to solve it.
Okay, thank you. Just 2 more questions here, and then we'll have to end it for today. But first question is around incentivizing roofers and ultimately our plans for bringing in the feedstock.
Yeah. So whilst I think of on the back end of the facilities, I think the asphalt agreements, and my target is that the asphalt agreements will be 3 to 5+ year agreements, so long-term offtakes. I don't think we'll be able to do that with roofers on the front end, to be perfectly honest. Now, may there be some kind of nationwide partners we could have possibly under structural agreements. So I think these are likely to be contractually rolling 1-year contracts. I think to incentivize a roofer, the first thing you need to do is you need to be close to the landfill. We can't have people drive an extra 30K because that's just not going to work. So the first thing is get your site close to a landfill where they have to turn right rather than left, and it takes them 5 minutes less. The second thing is to discount versus landfill fee. But interestingly, a lot of the feedback from the roofers is, well, the discount's interesting, but what we really want is speed. So when a roofer goes to a landfill, he's literally in a queue with 20 other trucks, and he's not the only asphalt guy, but they don't prioritize asphalt over anybody else. We will literally have a truck in and out in 15 minutes. Now, if you chat to Gord Johnson at the site, he says we can do it in 8. But the last part of the next part of the marketing strategy, I think, is the killer marketing strategy, and that's we're going to give them all coffee. So we will have food trucks on our site, and we will be giving whether it's coffee or coffee plus a donut, we'll have to see what Kelly's budget can stand. But that's all about sustainability, and that will be kind of like a local business. That's not, you know, it's not going to be Tim Hortons, I don't think. But yeah, so that's all about making sure we incentivize the driver to turn left, not right. And then the last thing is, look, a number of these roofing companies, and it's interesting when I talk to people in Calgary who are getting the roofs done, they're like, oh, I talked to my roofer about, you know, and a number of the roofers are kind of like, as they see their loads going into landfill, they're like, there should be something we can do about this. So we want to work with those roofing companies to make sure that we incent them more to come to us, and maybe we'll discount their fees more when we can hit joint sustainability objectives. And I think for me, that's about making sure that we have people incentivized to come to the site. Sorry, I would say the very last thing is, and we continue to talk about this, is when you're a roofer and you're coming to an Empower facility, the plan that we have, not done yet at Delta, is that you will have a sign at the front of that facility which will show you three things. Number one, it'll show you the last time we had a lost time accident, because it's really important that we keep our people safe. The second thing, it will show you how many tons that site has diverted from landfill. And the third thing it will show you is how many tons of CO2 have been saved versus the base case. So it's all going to be zeros in day one, but in 5 years' time, and our intention is to roll that onto the website as well. So you'll be able to go on the Calgary facility, you'll be able to go on the Toronto facility, and you'll be able to see those three measures. Because as an ESG company, that's what we need to deliver.
Okay. There's been a phenomenal amount of questions, so thank you very much for everyone's engagement here. I think we'll have to wrap it up. But thanks everyone. Thanks everyone for attending today, and Aidan, turn it over to you there to finish up.
Well, look, again, we will continue to do this quarterly. There'll be additional elements as we start to move the sustainability agenda forward. We'll have, you know, Kelly presenting what's going on there on our sustainability plans. As you know, a number of you ping me regularly to chat to us. More than happy to do that. Actually, if you want to go down to the next slide, I think it has the contact details. I mean, I think, pretty much all of you guys know this, but, Ken do a great job with our support. Carson, Director of Corporate Comms Development, and kind of our internal lead for IR. So, reach out. More than happy to take questions, and we'll continue with this transparency every quarter as we go. But thank you for attending, and great to have you on the call.